Welcome to the latest edition of The Bull, the Bear, and You as we take a look at the economy and investing. I'm Stacy Smith, and if you happen to like this program, we urge you to hit the like or the subscribe button on whatever platform on which you're watching or listening to the program. Boy, what a week we had that week when the markets tumbled on that Friday, continued to tumble on that Monday, and then by the following Friday, well, they were back to almost where they had started. We're going to take a look at what that big drop was like for the investor and also for your financial advisor. And also, we're going to take a look at why we had that big drop in the markets. That was an interesting week, and this week could also be very interesting with all the data being released by the government. We'll take a look at that. And when we have these drops, is it a buying opportunity? That's something we're going to discuss. With me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh. Also with us is Frank Rossetti of HF Management Company and Kim Forrest of Boca Capital Partners. Thanks again for joining me for The Bull, the Bear, and You, and let's see what we can't dive into what happened in the last couple of weeks. Normally with us, I should also say, is Michael Godwin for Gasso Advisors. He couldn't be with us today, but he'll join us again the next time we have our sessions. Now, the last time we met, all three of the major indices had just set new record highs. But within a week, all three dramatically dropped. In intraday trading on Monday, August the 5th, the NASDAQ was down 15.33%. The S&P 500 was down 6.5%. But this was from their all-time highs. But these markets have some buoyancy to them. By the time the closing bell sounded this past Friday, the three indices were just down 5%, or less than, I should say, 5% from their all-time highs. So I want to get into why all of this dramatic swing happened in just a moment. But Carrie and Kim, you deal with clients all the time. Frank, you used to, but you're not dealing with the everyday client anymore. So I'll have to ask Carrie and Kim, what was the last week and a half like for you and your clients on this wild swing that we went through?
Go ahead, Carrie. You're more client focused, so you go first.
You know, I have to be honest with you, and I think a lot of it is just the experience. I mean, I've been doing this now for some crazy amount of time, like 35 years, and there is nothing more satisfying as an advisor than to be able to be on the phone with a client that is confused, doesn't understand, has some fear, and be able to explain and distill what's actually happening in the market. And at the end of the day, I think that what we experienced was really very normal, very natural. We're definitely watching signs, and that's what we're telling clients. We're watching the consumer. And all of this was generally sparked by an unemployment number that had moved more than anticipated. So all of a sudden, people were thinking the economy's going into recession. And, you know, I can't tell you whether we are or we aren't, but what I can tell you is that the data that followed, we then received an ISM, an Institute of Supply Management number on services, which is most of what our economy is made up of these days, that was actually better than expected. That's not the typical sign of going into recession. So to be able to walk clients through and explain, you know, what corrections in the market are, why they happen, how they happen, and really to explain that from our perspective, it's very healthy to have that happen. You know, they don't understand that because they just see the numbers, but when you can help walk them through it, that's really where I think we earn our keep, number one, and it just helps to calm their nerves.
Yeah, and it was a frightening drop in those 2 days. I mean, you had a drop on Friday, and then on Monday it even went down more, and you had these big gaps between what the close was the day before and what the open was for that day. So, Kim, what was it like for you?
So I have relatively few direct clients, and for whatever reason, nobody was really upset, and I love that. So I didn't have to talk to people, but I did have to talk to a lot of reporters. And reporters were trying to figure out what the heck was going on, as that's their job. although Carrie is correct that this kind of the beginning of the earthquake started on Friday, but it was exacerbated not just in America, but in Japan. Now, Japan has, I can't remember how many people, probably half as many people as in the United States, but they're a very different country. And right now they have extraordinarily low interest rates. And hey, anybody that's checking out here, you have to, come on back. But because this really does play into our stock market. But they have been borrowing in yen and then buying American both debt, because it's way more than 0.5%, right? If you want interest, you come to America and buy our debt. But also they've been in very, the NASDAQ, the companies with the most risk, the AI companies. So they have been putting their money to work in very risky ways with borrowed money. That is a formula for disaster. And as we know, the price in the stock market is always set by just the last transaction. And a lot of people in Japan had to unwind their debt because whoever's running their Fed or their central bank has said they're going to start increasing rates. And that caused borrowers to fear. And then with the US kind of maybe slowing and the most risky stocks coming down fastest, that drove those small handful of sellers over in Japan to make our stock market look even less. It drove the prices down way quickly. And that buying and that selling went on very quickly, very rapidly. And I think that improved throughout the week. So that is an undercurrent that doesn't have anything to do with anything in America, really. But it really has affected our market.
Okay. Now, Frank, I presume what we've heard from Carrie and Kim, all play into what I'm going to ask you here. And I don't know that if it's an economy class 401 or, a 501 class, but so if you can, without getting too detailed, give us an idea of your take on exactly what happened and why we had this dramatic drop.
Well, fortunately, the complicated part of it was just explained by Kim.
Okay.
All right. And it was leverage hedged using hedges to Japanese currency and loans at low interest rates versus the US dollar. And when Japan raised their interest rate, that whole dynamic changed and caused hedge funds, not people, hedge funds basically, and institutions that do these sorts of things to start unwinding their positions, which caused the precipitous drop in the market. And then add into that the employment work, which on the surface looked terrible, but once people had a minute to drill into it, it became a non-event. It really wasn't that big of a problem. People are coming back to work, which, by the way, is a good thing. That'll make customers have more money to spend, which will help sales down the road. Not this month, but down the road. And that being said, hopefully this was brief enough. Now, Stacey, you know me well enough to know that brief is not part of my world.
Okay. Well, but help me with just this part of it. The drop started on Friday at 8:30 in the morning with the futures when the July jobs report came out. So when did the Japan aspect of this start to help the snowball?
Well, 8:30 the markets were not open.
No, but the futures are, and you can get a pretty good idea of what's starting to happen there.
And as far as when Japan made their announcement, I have no recollection of that. I didn't look it up. I don't know. And it's a large reason. And if you look at today's Wall Street Journal, what you'll see is them talking about nothing about employment, everything about Japan. And the question becomes, how long will this unwinding take? Is it largely over? Isn't it largely over? No one knows quite how big it is. And some say it's mostly over that ought to know. And some who ought to know say there's still a lot to come. And of course, I have no clue who's right.
And in 97, there was something similar to this.
Mhm.
Long-term capital, if anybody remembers those three words that are
Mm-hmm.
together, they were a new hedge fund full of Nobel Prize winning economists who thought they couldn't lose on leveraged bets on developing world currencies. And that sounds really backwater-ish, but it brought our stock market down rapidly in many of the same ways. And I think a lot of people are looking at that thinking it's the same sort of mechanism where people who were borrowing money had to quickly get out of positions. And in that case, it was foreign exchange, and that's always tough to get in and out of. That's a very murky world. But it's hard to know if things are over. We'll tell you in about 6 months. Sorry.
Well, one final question, and that is, as the markets were declining on Friday and on Monday, was it broad-based, Carrie? Was it all the different kind of sectors and all the different, whether it's value or growth and that sort of thing?
Yeah, I mean, we did see it was broad-based, but some sectors did not go down as much. Other sectors went down more. You have traditionally defensive sectors, like utilities and so forth, that generally don't go down as much. But for the most part, it was pretty broad-based, just at different levels. Now, the good news for all of our viewers who are watching this kind of a little maybe confused, the fact that it's explainable and we who deal with this every day understand it, um, is a good thing. You don't get hit by the bus you're watching.
Mm-hmm.
So, if that provides any confidence, this is not what we would consider at this point a systemic issue. It's something we've been through and experienced before, and we understand how to maneuver around it and also stay calm.
Okay, I hate to keep going on this subject, but as you're looking at the portfolios of your clients and perhaps your own, when do you start to think maybe this isn't going to be over quickly, or maybe I misjudged this thing?
Well, I'll tell you from our perspective, we ask that question every day.
Okay.
We know that every day, tomorrow morning, it's like I said, it's the bus that you're not watching that hits you. So we have to be prepared for that. Like Kim referred to the long-term capital
Mm-hmm.
event, we have to be prepared for that. So we have to make sure that whatever stocks we own, whatever investments we own, that we feel good that we could ride through an event.
Okay, good. We have to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We're talking about that wild swing in the markets this past week. And if the July jobs report shook the markets, this week could be interesting as well. On Tuesday, the first of 2 days of reports on inflation come out when the producer price index is released. And then on Wednesday, the consumer price index is released. Thursday will bring us the latest retail sales number and the latest latest report on U.S. industrial production as well. But wait, there's more, as they say in television, at least television commercials. On Friday comes the data on housing starts for July. And I guess, and this is one of those things I'm not that familiar with, but should we lose sight on the bidding for Treasury bills today and tomorrow? So, Kim, that seems like a lot of information that could swing the markets, or am I just misjudging this?
No, you have nailed it. And why do we care? Why do we care? Well, a couple of things. Just like earnings season, all this data are bits of the mosaic that lets us understand, is the economy getting better or is it getting worse? This is what we ask ourselves every day. And not just professionals, but viewers that are in the market as well. So we'll be able to get a view a little bit in reverse, right? Because we can never look into the future. We only look into the past to see how things have been and get some definitive numbers. But probably the more important thing that all of the people are watching is, what is the Fed going to do in September? Is it going to lower rates? And if the numbers still keep looking like we've made that mythical soft landing, which means not a whole lot of job losses and we would have inflation, decreasing, then that is what exactly the Fed has said, that it would cut rates. And we want to see cut rates because right now it feels as if maybe interest rates are holding people back from buying things like cars, houses, those kind of things. So we would like to see the Fed lower interest rates to have a less restrictive interest rate policy. And that would drive growth, hopefully not too much. So that's why all this information this week is on our minds.
So, I've often said, be careful what you wish for. And we had a little bit of an experience of that last week when we had that unemployment number. Because I actually had a client ask me, like, wait a second, if the unemployment number isn't what we wanted, and that means interest rates will be going down, well, isn't that a good thing? And I have kept saying on this program, be careful what you wish for, because when the reality sets in that the Fed's going to lower interest rates because the economy isn't doing well, the investor has already gone to the worst case scenario, which is this is a deep recession, and sell your stocks. So as we get the data out this week, and this is like, Christmas week for people like us, there's a lot of data. As we get this data out, we'll probably be getting, if the data is not good, we'll probably be getting calls about recession. And what I always tell people is, let's play this out. Like, if we have a recession, it doesn't stop there. Then the Fed, as Kim was saying, will lower rates and until the point that people spend more money. It's called the normal economic cycle, and we know how to maneuver that.
Right. Okay. Frank, your thoughts?
I don't think anyone on the show ever suggested there would never be another recession. And no. I've said there will be another recession. Don't ask me when. Still don't ask me when. I don't know if it's around the corner or it's going to happen in a year or two. I don't know. It'll happen when it happens. And we all manage money with that in mind. There's always a piece of our assets that are invested in a way that will be less affected by the reality of the next recession. And what we do, all of us, is when that happens, we may strategically, tactically adjust that and have a little less defensive assets because we have a buying opportunity. We had a mild one last week, and it wasn't, I don't think, officially a correction other than in the NASDAQ. Uh-huh. And that being said, it was just a cleansing, if you will, like the April rains.
Okay. Well, that was a nice segue to go into. Oh, Kim, you had something else you wanted to say?
Well, I just want to make people aware that it's folly. It is folly to try to maintain the dollar amount of assets when you have them invested in something called risk assets. Risk assets? Hello. That would be like trying to go to the ocean and not have high tide or low tide. It's ridiculous. It's going to happen. What you're counting on your advisor to do is make sure you have enough cash flow, but have the temperament to be able to look at the basket full of companies that you own and say, they're pretty good, they'll make it through whatever, and we're going to move on. And I think that's where we kind of lose our minds, where people look at a dollar amount and say, I had $100 and now I have 80. What am I going to do? Well, no, you don't have $100. You own $80 worth of stocks. That the prices change. Come on, people. Prices change.
Okay. All right. We need to take another break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We're going to continue our discussion about that big drop on 2 days and then the big swing back upward again. So, Carrie, you and the others have stated time after time on this program that pullbacks are an excellent time to be a buyer. And Frank just mentioned that a moment ago. So was that the case during the big drop on that Friday and Monday?
Yes. So here's the other interesting thing is it's also earnings season. Yeah. So not only, it was really fun for us. My team hates when I use the word fun for stuff like this, but, earnings give us a lot of information and a lot of information about companies going forward. So for those companies that had reported, we kind of knew which companies or which stocks we might want to rebalance and trim. And we also knew, because our process is that we identify those stocks that are, we would call on our shopping list. And a lot of those companies, we have them tagged to buy at a cheaper price. So when we see a drop like that, we know exactly where we want to execute. The fact that earnings gave us some free cash because there were companies that were like, this isn't looking good. Let's change this position to another position. It really is an opportunity to rebalance portfolios and get them aligned for how we think the future may play out.
But you have to be pretty nimble in this particular time period, right?
Well, and
you did, but did give you the weekend to do some consideration too. Yeah.
I mean, I'll be honest, and I this is maybe a little bit of a commercial, but it's one of the values of working with a more of a boutique type investment advisor, because we have such a hands-on approach and a personalized approach to what we're doing, where we really have the team and the processes in place to be nimble. And I'll tell you, sometimes we'll make a change in one portfolio because it's a more conservative, older investor taking income. And that same position, we may let it ride for a younger client that has a longer time frame. So, that's really where you need to understand what type of advisor you're working with, and are they nimble? Do they have the ability to be nimble?
Yeah.
The thing that Carrie said just now is important, because with a younger, longer time horizon person, to be flipping stocks around just because they happen to sell off a little bit that you actually like the company creates possibly a negative tax implication. You might not want to realize whatever gain is left, realizing that a month or two or a year or two from now, the stock will be back to where it was, maybe higher. And you'll have exposed your client to taxes unnecessarily. Now, if, as we've all talked about over the years, you've harvested capital loss through the course of the year and you have these things sitting there, it's a lesser problem. But it all comes down to, and I'll do a commercial for my son's business as well as Carrie's business. We spend a lot of time making plans for events like happened last week. And what happened, we have shopping lists of what we will buy, as Carrie alluded to. And we will, when the event happens that creates the opportunity, and I underline and capitalize, this created an opportunity. Is it the ultimate opportunity? Come back in 6 months or a year, I'll tell you. And and we execute on that opportunity that presented itself because we were prepared for it.
Yeah. So Kim, you do it a little bit differently than Frank and Carrie, in that you have fewer clients that you advise, but you do analyze these stocks. And so when something like this happens, I mean, you must be just, nose to the grindstone trying to figure out which ones you want to keep and which ones you think that should be bought.
Well, it's funny. Carrie brought this up every single day. She looks at, the world and says, what is happening? And I'm sure she does this with the stocks that she runs as well. I do the same thing every single day. I don't care if markets are good or not. I'm asking, is this the best the company is ever going to be? Should I sell it? Or is this an opportunity to buy a company on my list? And I did get to buy, I can't tell you which, a company that I've been wanting to add to portfolios that I've watched for a long time. And, I had to make a decision. Is it going to get better? Oh yeah, heck yeah, I think so. So we bought. So this every day is an opportunity. And it really, sometimes the markets aren't going crazy, but a single stock might be. And it's so far down on the list, CNBC isn't even talking about it. Who cares? Let's buy it. And I think in these, and I'll be an advertisement now, in these smaller firms where we don't have committees and, we meet on Fridays, we can't make decisions on a Tuesday. We can make decisions and we are very nimble. So I would make sure that people realize that about a smaller firm, that we have the liberty to take action when it presents itself. And we look every single day, even when we're on vacation. Let me tell you that.
Well, and here's something else that's super, super important. You know, for just about every one of our clients, their largest expense are taxes. And yes, we're looking for opportunities when we have events like we did, but we are also looking to tax loss harvest all the time. And sometimes that means an easy swap, especially if we're in a situation where a company has already reported earnings and we kind of have alignment. And unfortunately, I can't mention individual stocks, but we can go from one stock that's in a sector and flip it same day, because we don't want to be out of the market even for a day, flip it into another stock in that sector, very similar. We know they tend to move in alignment, and we can capture a loss without giving up really virtually very little upside potential, assuming there aren't any events with those companies, which is why we like to do it after earnings are reported. But I can tell you that we capture tens of thousands of dollars of tax losses doing that for our clients, which then enables us to rebalance and take gains and not have to pay taxes. So it's a very important function to managing money.
Well, then this also leads to my next question, and then we'll probably wrap it up after this. But I've always wondered, when you say these are buying opportunities, does your client always have enough money sitting on hand, or is it because you can start to say, all right, this company's not doing as well as we want, we'll take the money from there, worry about the tax part as well, and then turn around and make that using that fund to buy the stock that you like? Is that how it works?
Well, using Carrie's example, if you have racked up some losses, it doesn't really matter. What I do is I try to trim positions that have done really well and are getting close to my uncomfortable range, which is like 7% or so, or 6%. 8% is like I'm having a heart attack. But because we don't want any one stock to be able to influence the portfolio, like, greatly. We don't. Bad things happen to good companies every single day. Anyhow, back on track. So what I do generally is I'll trim the overweight good names that I love and make position, and raise the money that way. It doesn't just mean sell the losers and buy a winner.
Okay. All right. That makes sense to me.
Yeah.
Frank, you have anything to say? Wrap it up. Oh, I'm sorry, Carrie, you wanted to say something?
I was just going to say something really quickly, is that in a time where you have extreme market volatility, a lot of it is you might have some cash, but then you're getting cash from other places. But during normal market environments, if the market's up, we're much more likely to take a gain and sit on the cash and wait for the market to come back down so that we have dry powder available. So it really
Okay.
depends on what the circumstances are.
Yeah. All right. Frank, you want to wrap it up for us?
Yeah, Kim said something that is critical for people to understand. She used the word trim. All right.
Yes.
The word trim means you get a little overweight. Your portfolio becomes, the S&P 500 cannot trim, although the equal weighted one trims automatically. And if you don't want to be like the S&P and have a 16 standard deviation, which is pretty high, which means high risk, all right, you trim this magnificent 7 down. You get out of them. Of course, they're wonderful companies. That doesn't mean you need to have 30% of your money in those 7 stocks. That's high risk. And people don't seem to understand that. Trimming means you sell some of it.
Okay.
Maybe a small amount. It's very important.
Yeah, makes sense. Well, I thought that was a great discussion today. We'll continue to look at investing in the economy in future editions. And if you like this program and want to see it continue, I ask that you press the subscribe or the like button on whichever device or I'm kind of thinking of the word, platform, whatever that you're watching. And if you do that, we want to thank you for doing that. That's it for now. So thank you for joining us, and we'll see you again in about 2 weeks. Bye-bye.